welcome. Welcome to this webinar on Social Security. We are so happy that you're here. Allison Alley is a certified financial planner here at Pure Financial Advisors. She's going to be leading our Social Security webinar. I'm Catherine Bowie, the Director of Education. So welcome, Allison. How you doing?
Hi, good. Thanks. How are you doing?
I'm doing great.
All right, let's get started. So we're going to go through Social Security. Let's start at the beginning. So Social Security was written into law back in 1935, but payroll taxes didn't start being collected until 1937. Originally, they gave people a choice of taking a lump sum or a monthly payment. In the first couple of years, everybody took the lump sum, with good old Ernest being the first American to receive a lump sum payment in 1937. He received a total of 17 cents, and he had paid in 5 cents to the program. The first monthly check was issued to Ida May, and she paid a total of $24.75 into the system for 3 years in 1937, 38, and 1939. Her first monthly payment that she received was for $22.54. So she had almost gotten her entire contribution to the system back just with that first payment. By the time her second check was received, she'd obviously already gotten everything back. Over her lifetime, she collected just under $23,000 in Social Security benefits, having only contributed roughly $25. So that was a return of over 92,000%. Obviously, things have changed a little bit since then. There's no lump sum options. The option is there's no option at all. You just get a monthly check once you decide to start claiming. And I don't think anybody's getting a 92,000% return on their contributions at this point. So let's get into how it works and what things look like. Social Security benefits can play, obviously, an important role in your retirement income plan. Often it's referred to as part of a three-legged stool. Often people have Social Security benefits, you might have a pension, and you might have other personal retirement savings, 401ks, IRAs, things like that. So this is going to be part of your retirement plan. And so we'll kind of get into what that'll look like. And the things that go into determining what your benefit's actually going to be. Your age, your current and prior earnings, your spousal earnings, whether you're married, divorced, a widower, etc., whether you have a disability, and whether or not you are covered by a pension. There are government and city pensions out there that if you're under them, you don't pay into Social Security while you're participating in those pensions. If you have a pension like that, you will likely see your Social Security benefits impacted in some manner. All right. Currently, nearly 9 out of 10 people age 65 and older are receiving Social Security benefits. Among elderly beneficiaries, 12% of men and 15% of women rely on Social Security for 90% or more of their retirement income, right? And we'll get into it. And Social Security was not designed to replace 100% of your retirement income, right? It's to give you some safety and security in retirement, but you really do need to concentrate on building other sources of retirement income so that you're not dependent just on your Social Security benefits. Okay, let's talk about the changes that came into existence this year, 2024. This year, people got a 3.2% increase in their Social Security benefit. So every year there's a cost of living adjustment on your Social Security benefit. Last year it was higher. This year it was 3.2. The Social Security Administration attempts to keep up with inflation. However, I will note that over time, it does not keep up with inflation. So that's important. In addition, the amount of income somebody's earning, there's a limit to how much income is actually subject to Social Security tax while you're working. And that tends to go up each year as well. This year in 2024, the maximum taxable earnings that you could have Social Security income applied to or taxed on was $168,600. If you earn more than that, those additional dollars are not subject to Social Security tax. If you decide to continue working once you take Social Security, if you take Social Security before your full retirement age, the maximum amount that you can earn before having your Social Security impacted is $22,320. If you earn more than that and you started Social Security early and you're under your full retirement age, you will have $1 deducted from your Social Security income for every $2 of earnings over and above that $22,320. And again, that goes up each year as well. So something to factor in and a consideration if you're planning to take Social Security early, if you're going to continue to work. Okay, let's get into the rules of Social Security benefits. Some frequently used terms that we'll be referring to: full retirement age, or FRA. That's the age at which a person becomes entitled to receiving their unreduced retirement benefit. Primary insurance amount, or sometimes referred to as PIA, is the benefit that you would receive if you start taking your benefit at your full retirement age. And then the Social Security Administration, or the SSA, that's who governs Social Security. It's also the website, ssa.gov, that you can go to if you haven't already, to find your most recent Social Security benefit projections. They used to mail statements out every year. They don't do that until you're much closer to retirement age. So along the way, if you want to check on your earnings history, your projected future benefits, that's the website you go to, ssa.gov. All right, calculating benefits. This is just showing birth years and correlating full retirement age. So somebody that was born in 1958, their full retirement age when they're eligible for 100% of benefits is 66 years and 8 months. 1959, 66 and 10 months. 1960 or later, it's age 67. If you decide to start your benefit early, you can start as early as age 62, but you're going to be reduced in the amount you get. And this is just kind of showing that. So if you're entitled to full retirement age at 66 and 8 months, if you were to start at 62, you would only get 71.67% of your full benefit, and so on. Along those lines of collecting early and what people kind of expect, they do studies and there's research done. And when people have been asked, a majority of people, about 65% of people, assume that they're going to wait until 65 or later to retire, right? So that factors into Social Security when they think they're going to claim the benefits. Most people think they're going to work and wait till at least age 65 or longer to retire and claim benefits. However, real life happens. And as it turns out, more like 70% of people actually end up retiring and collecting benefits 65 and younger, right? Things happen, health issues, job layoffs. I mean, the list goes on and on of why somebody might retire earlier than they had previously been thinking, and therefore need to start their Social Security benefits again sooner than they anticipated. So what's the impact of that? Well, this is assuming somebody's full retirement is age 67. If you were to start earlier, this just shows year by year the amount of the reduction in what you would get, right? So you start a year earlier, you're going to get 7% less, 13% less if you start 2 years earlier, and so on. And again, it's about a 30% reduction if you started at 62 when your full retirement age was 67. However, on the flip side, there's a benefit for waiting to take Social Security. If your full retirement age is 67 and you wait, you get an 8% increase per year every year you delay taking your benefits. And there's not a lot of places with a guaranteed 8% increase. So this can be beneficial over time. Certainly there's trade-offs to this and other factors that you would want to consider, but there is a pretty significant benefit to waiting to take your Social Security income. And here are kind of the things that might go into that decision, right? Are you going to continue working even part-time before your full retirement age? If so, you probably don't want to take it. How's longevity? How's your health? Did your parents live to their 90s, grandparents, et cetera, right? Is there a family history of longevity? That might make you want to wait to take it if you're going to expect to live longer. Getting those higher dollar amounts for a longer amount of time can be really beneficial. And then what is your marital status? Are you married? What's the age difference between spouses? Whose benefits are higher? Whose can collect on whose earnings record? All of those things will factor into the decision to start early on time or even late. Okay, let's talk about that earnings limit. If you start claiming your Social Security before your full retirement age and you're going to continue to work, again, that limit for this year, $22,320. If you earn more than that, $1 of your Social Security income will be withheld for every $2 of earnings over and above that limit. In the year you turn your full retirement age, but you aren't yet your full retirement age. So let's say your birthday is in August, and that's when you're going to hit full retirement age. If you're working that year, the amount you can earn before your birthday is actually a little bit higher, right? It goes up to $59,000. And if you earned more than that, $1 of benefit would be withheld for every $3 of earnings above the limit. So there's a little bit more wiggle room here. There's a higher amount, a lesser penalty per se, and it only applies to the month before full retirement age. Once you hit your full retirement age, there's no limit to the amount you can earn, right? So your full retirement age is 67, you hit 67, you decide you're still working, you want to keep working, you can earn as much as you want, and your Social Security benefit won't be reduced. It's fine. Okay, let's talk about life expectancies upon retirement. So they've done studies of how long people are expected to live. And again, this plays into the timing of taking your Social Security income. A married couple currently age 65, there's a 63% chance that at least one person will live to age 90. There's an 85% chance that at least one person will live to age 85. When they look at individuals, singles, a single female aged currently 65 has a 45% chance of living to 90 and a 66% chance of living to at least 85. Men slightly lower, right? Women tend to live longer. So a current male age 65 has a 33% chance of living to 90 and 55% chance of living to age 85. So again, these just kind of national averages, as well as your own health and family history, will go into those decision-making factors. All right, let's talk real people, or hypothetical real people. We've got a couple, married couple, David and Carol. David was the higher wage earner, Carol was the lower wage earner, and they're the same age, so both of them have a full retirement age of 67 in this example. So what are we looking at? Based on their earnings records, David's full retirement benefit is $2,200. Carol, being the lower income earner, her full retirement age benefit is $600. But the spousal benefit comes into play here. When you're married, the lower earning spouse is entitled to the higher of their own benefit, in this case, $600, or 50% of their spouses. In this case, David's benefit is $2,200, so 50% of that would be $1,100. So if they were to both file for benefits at age 67, David would get $2,200 a month, and Carol would get 50% of that, $1,100 a month. Okay, pretty straightforward. Let's look at what that translates to and the maximum amounts. Similar to your own benefit, if you start taking it early, if you're entitled to the spousal benefit and you start it earlier than full retirement age, it's also going to be reduced. However, there isn't any benefit in waiting past full retirement age if you're going to be getting the spousal benefit. It can never be more than 50% of the higher earning spouse's full retirement age amount. So in this case, Carol entitled to $1,100 at full retirement age, that's 50% of David's. She's never going to get more than that if she were to wait. So there's really no reason to wait. So let's look at what that would translate to. And here's how it's calculated. So again, full retirement age, her own benefit is that $600, and then she gets the amount that brings the total to the $1,100. If she were to start early, her own benefit as well as the spousal benefit is reduced. At 62 in this example, she'd get $745 instead of $1,100. If she were to wait, while her own does increase, as we've talked about, the spousal benefit would then just get reduced because the total maximum would stay at $1,100. Okay. Survivor benefits also play into this. So survivor benefits are what a spouse is entitled to when another spouse passes away. So when one spouse passes away, the surviving spouse is going to continue to get the higher of the two benefits that were being received when both spouses were alive. So in this example, we've got the same original David's benefit 2,200, Carol's at 600. But if he were to have started early at 66 and 6 months and was getting the 1833 that he would have been entitled to, if he passes away first, Carol will continue to get that 1,800, not the lower spousal benefit she would have been getting while he was still alive. Similarly, if he had waited until 70 and he was getting the 2,900, even though Carol would have been getting the 1,100, if he passes away first, she will then switch to getting what he had actually been getting. Her 1,100 will stop, but she would start getting the 2,900 that he had been getting. All right. Let's talk about how this kind of really plays out. So a couple of things. This example we're going to look at is same benefits. The assumption here is that we're going to start them early at age 62. David's going to live to 75. Carol's going to live to 85. If he started at 62, he's going to get 1,540. Carol's going to get her own reduced amount, 420, plus the reduced spousal amount of 325. So this amount together, when we look at what they would get over their lifetimes, starting at 62, David again living to 75, Carol living to 85, David's benefits would equal $240,000. Carol's own benefit would equal $65,000. Her spousal benefit would be $50,000. If he passed away at 75, but she lived till 85, she would then have 10 years of getting the survivor benefits, $217,000. So the total Social Security received between the two of them during their combined lifetimes would total up to $574,000. All right, now we want to look and say, well, are there ways they could have gotten more? Let's look at if they started at age 67 instead of 62. 67, he's going to get his $2,200 a month. She's going to get her benefit, the spousal benefit, totaling the 1,100. And again, same life expectancy. He lives to 75, she lives to 85. That gets them combined a total of 580,000 compared to them starting early, 574,000. So a little bit more because they waited until 67 and got the combined higher amount. And that's the survivor benefit still applied after he passed away early. Let's look to see what happens if they waited until 70. But he's again only going to live to 75. So that's an important factor, right? He would get the higher amount from waiting. So instead of $2,200 a month, he'd get $2,700 a month. Her amount would be higher. The spousal would be lower. The combined would still be the 1,100. The totals here are actually worse off than both of the prior examples. And that's because in this case, his life expectancy was only 5 years past when he started claiming. And obviously nobody knows that when you go into this, right? We don't have a crystal ball. We don't know how long we're going to live. But in this example, them waiting until 70 actually turned out worse again than starting early or even waiting until age 67. So what else? What are the other options out there? What are the other possible scenarios? How could we see a large difference in benefits? So in this case, we're looking at similar situation, but let's say Carol started her own benefit early at 62. So she started getting $420 a month. And then David started his at his full retirement age. So he started getting $2,200. You don't get to take the spousal benefit until the higher earning spouse actually starts claiming their benefit. So if Carol started at 62, she'd have 5 years of just getting the 420. Then David would start at 67. At that time, she would start getting the additional spousal benefit. And then that gets them the most of the scenarios we've talked about, right? So she would have a period of time just getting a little bit, then hers would additional amount, the spousal amount that she could get would go into effect when he started getting his, and then the combined benefit works out higher than everything we've looked at previously. What if there's longer longevity in the family or for individuals. So in this case, we're going to look at similar situation, but now David's going to live to 85 and Carol's going to live to 92. So in this situation, we're showing, well, what if then David started at 70, Carol started her own back at 67, and then her spousal benefit stacked on top at 70 when David starts, because again, you don't get to take the spousal until the higher earning spouse is claiming their own. Well, and in this case, they've got longer years ahead of them. And now the total, because he started at 70, but's going to live to 85 and is getting a significantly higher amount. She starts her own at 67, gets the higher benefit at 70, and she lives to 92. This combined amount gets them $900,000 if they lived to 85 and 92 respectively. You can also see what would happen in the same situation, in the same projection of age, with full retirement age, both 70, and this combination. So if you have longevity in your lineage, you can see how waiting can be incredibly beneficial over time. And I mean, this is, several $100,000 more Social Security income than any of the previous scenarios, with them living to only 75 and 85 respectively. So that has to be factored in. So even if you get divorced, you could still be entitled to the spousal benefits based on the earnings of your ex-spouse. If you were married for at least 10 years, you're currently unmarried, and you both are at least age 62. And if you've been divorced for at least the last 2 years, then you actually don't have to wait for your ex-spouse to be claiming benefits before you can claim benefits. So just because you get divorced doesn't mean that you aren't entitled to spousal benefits based on the earnings record of your prior spouse. I was going to say similarly, it's not really similar, but if you are a widow or widower, you will be entitled to those survivor benefits as long as you were married to your deceased ex-spouse for at least 10 years. So if you're divorced and your ex-spouse passes away, you can still be entitled to the survivor benefits. You have to still be unmarried or remarried after age 60, and you have to be at least age 60 to be entitled to survivor benefits. And again, the survivor benefits are going to be what that ex-spouse was actually getting. All right, before we get into taxation, I'm guessing we have some questions.
Wow, you guessed right. Okay. So she's 64, the higher paid earner. This is the one. Her husband's 12 years younger and also retired. She's considering taking the Social Security in the beginning of next year. So what is the best strategy for her husband collecting Social Security?
So it kind of depends on the rest of your situation, but if you started next year, so that'd still be early, fine. He still wouldn't be able to claim any benefits until he's at least 62. So 62 is the earliest you can start benefits. It would be early. At that time, if he did decide to start claiming benefits at his age 62, he would get the higher of his own benefit based on his earnings, or the spousal benefit based on hers. So there used to be other things you could do, but they kind of got rid of those little loopholes. So if your higher earning spouse is claiming benefits and you're the lower earning spouse, when you start, whether it's early or not, you're just going to get the higher of your own or the spousal benefit, which however that gets calculated at that time.
And they don't have to switch. Someone was asking, when you file for your benefits, if you are filing early, you get your own benefits. And then when your spouse starts taking theirs, that's when you get the spousal. So it's not switching, it's just adding.
Yep, exactly.
And how does spousal benefit work when the lower wage earner receives a state pension and the lower wage earner will also receive Social Security benefits subject to WEP?
Yep, then the spousal benefit, the original spousal benefit is still going to get calculated, and then the WEP calculation. So I think there's slides about this, but it's the windfall elimination provision. That will get calculated and will reduce down what that person otherwise would have been entitled to.
Um, do you know if you can collect disability and Social Security at the same time?
No, you would get, like, if you're entitled to Social Security disability income, once you hit the age of being eligible for Social Security benefits, it will just switch from being categorized as Social Security disability income to Social Security retirement benefits.
And then lastly, what if the higher earner dies before they start receiving benefits? So the spouse passed away prior to Social Security. Can the lower wage earner still have access to their spouse's intended Social Security benefits?
Yes. So if the higher earning spouses passes away before the higher earning spouse was claiming benefits, the surviving spouse would still get the survivor benefit based on the higher earning spouse's eligible benefit.
When they become at least 62 or have a dependent.
Yeah, and actually, and again, as a survivor, you could start technically as early as 60. So that's an option. You can start a little bit earlier as a surviving spouse. It would still get reduced, right? If you start your own benefit, if you start the benefit, whether it's the spousal or the survivor, whatever, you start it before your own full retirement age, it's still going to get reduced. So you could start as early as 60 as a survivor, but it's still going to be a lowered amount than what you would get if you waited.
Okay. And then actually one more. If I switch, can I switch my benefits at age 70 after claiming survivor benefits? So can she have survivor
Yes.
benefits without claiming her own benefit
Yes,
and
you
wait
can.
till 70?
Yes, you can. So you can get survivor benefits if your spouse passed away. And then if your own benefit at 70 is higher, you could switch to your own benefit at 70 after getting the survivor benefit earlier on.
Okay. We have a few others, but we'll go ahead and wait because some of them are a little detailed, but
Okay.
go to the next section.
I'm guessing that the taxation of Social Security will
Yes.
add additional questions.
Yes.
All right, let's get into the taxation of Social Security. All right. So whether or not your Social Security is taxed is based on how much other income you have. So there's something that gets calculated called your provisional income. Your provisional income is made up of half of your Social Security benefits, your any dividends, capital gains, etc., and any other non-taxable interest, and the rest of your income. So the rest of your adjusted gross income, dividends, capital gains, non-taxable interest, which while you don't pay tax on it, it's factored into this calculation, and then half of your Social Security benefits. So that number gets calculated and then it gets applied to the scale. So if you are single and that provisional income is under $25,000, you will not have federal taxes on your Social Security income. If that provisional income is between $25,000 and $34,000, up to half of your Social Security could be subject to tax. If your provisional income is above $34,000, up to 85% of your Social Security income could be subject to tax. However, never will more than 85% of your Social Security income be subject to federal tax. For married filing jointly, exact same concept, but the numbers are a little bit higher. 32,000 it can be and not have any taxes. Between 32 and 44, up to half of your Social Security income could be taxed, and over 44,000, up to 85% of your Social Security could be taxed. These are just the federal rules. Right? Every state is different. In California, does not tax Social Security income. Only a handful of states do. So you want to check that out, whether or not in your state your Social Security income is going to be subject to state tax. All right, let's look at an actual example of this. And this illustrates what kind of income you have and how it determines how much your Social Security is going to be taxed. So in this situation, this person has $20,000 of Social Security income and takes $40,000 from their IRA. So their provisional income, because it's half of the Social Security benefit and then the rest of your income. So half of 20,000 is 10 plus the IRA distribution. So $50,000 of provisional income. And so what happens is that scale that we were just looking at gets applied, 50,000, they take off the first 32, so 18,000, half of that is subject to tax. So the first 9,000 is subject to tax. And then the next chunk, the 50,000 to the 44,000, the additional 6,000, 35% is subject to tax. So that's where that 85% is the 0.5 plus the 0.35, right? So 85%. So $2,100 of that is subject to tax. So total, the 9,000 and the 2,100. So of the total Social Security received, 20,000, 11,100 is subject to federal tax. So 55% of this person's Social Security income is going to show up on their tax return and be subject to federal tax. Another situation, the person has the exact same amount of income, but it's different sources. In this case, they have $40,000 of Social Security income and $20,000 of an IRA withdrawal. So it's still $60,000 of income, but the provisional income is lower because, again, it's half the Social Security, so 20,000, and 20,000 of the IRA. So a total of 40,000 is what the provisional income works out to be. The same scale gets looked at, but in this case, 40,000 minus the 32, so $8,000. Half of that is subject to tax, and there's nothing above that $44,000 threshold, so no additional dollars are subject to tax. So this person only has 4,000 of their $40,000 subject to federal tax. So even though they had the same amount of total income, because more of their income came from Social Security, they have a lower provisional income, and less of their Social Security benefit is subject to federal tax. Okay. Questions on taxes before we get into potential things coming in the future?
I recently paid an overpayment penalty of $2,700 due to exceeding the allowed earnings amount last year. Penalty is supposed to be returned to me at some point. Can you explain the refund of the earned income penalty? And is it paid as a lump sum, or is there anything else that they should know?
So once you hit your full retirement age and are no longer subject to those earnings thresholds, then the income will be paid back to you. And so what you want to do is you can go on the Social Security website. Again, the ssa.gov, if you have an account, you create your user ID password, and you can go through there and find out like the amount you're going to be entitled to and how it's going to get distributed back out to you.
Yes, but it's not typically, as you were about to say, a lump sum.
Correct. Yeah.
Are survivor benefits affected by the windfall elimination provision?
Yes, except it's not at that point, if it's a survivor benefit, instead of being under the windfall elimination provision, it falls under the government pension offset. So GPO instead of WEP. So yes, like if you have a government pension and you're entitled to survivor benefits, those survivor benefits will be reduced for similar reasons, but it's technically a different provision called the government pension offset.
So a wife has a combination of Social Security benefits and pension benefits. So will she be eligible for spousal benefits when we're both at full retirement age? I guess if she makes less than the higher earner?
Yeah, you'd still be entitled to everyone's entitled to the higher of their own benefit or 50% of their spouse's benefit, whichever one is higher.
Right.
So if you have a pension, and keep in mind, not all pensions are subject to that windfall elimination provisions, right? Just pensions that didn't require somebody pay into Social Security while they were covered by that pension. Like private sector pensions don't impact your Social Security at all. It's just if you weren't paying into Social Security while you were covered by that pension. So somebody might have Social Security income and pension income, and if their own Social Security income is less than half of their spouse's, they're still going to be able to get that spousal benefit once the higher earning spouse claims. If their own benefit is higher than that, 50%, then spousal benefits don't apply.
Right. So someone else was saying if you could just comment on when the two earners are similar. So there's no benefit of getting spousal benefits if you're.
Yeah, there isn't a spousal benefit, right? Because if both spouses made similar amounts throughout their working careers, their benefits are going to be pretty similar, then they're each just going to get their own benefit because half would be less than what they would already be entitled to.
Right. And then you would just have to do the different scenarios of one taking it early and that sort of thing.
Correct. Then you would just want to run through like, okay, what are your other income sources? What are your other assets? Do you need the Social Security to sustain retirement? Can you pull from your own assets and let those Social Security benefits increase without jeopardizing the sustainability of your portfolio? How's your health? How's your longevity? All of those things would go into figuring out, who claims when at the same time, somebody before the other, and so on. Yeah.
And then lastly, when you're talking about the calculations of the Social Security tax and the threshold, the limit, is that for each earner when married filing jointly, or is that together that um they're
That is together.
got it.
Yeah. So that's just looking at your tax return. So if you're married filing jointly, your provisional income is
Right.
everything all in. So total 50% of total Social Security benefits. So that's why there's separate charts, right? There's a single chart and there's a married filing jointly chart. So if you're married filing jointly chart, that's what's going to apply to you. And it's the combination of everything.
All right. Well, those are the ones that I think can be answered.
Okay. So if you have additional questions, you can reach out to us for our Social Security analysis. That's completely free. You can go to our website, purefinancial.com, shoot us an email, or give us a call, and we're happy to set you up with that free Social Security analysis. In that analysis, we can go over your provisional income, your other income sources, your asset levels, any pensions that you have, to kind of help educate you on how it all works together and what the best strategy for you in claiming benefits might be. So if you have a change in your situation, you just got married, you got divorced, you had a spouse pass away, all of those questions we can help answer with that free Social Security analysis. The projections, right? The Old Age and Survivors Insurance Trust, that's Social Security, is projected to run out of money by 2033. It's 2024, so that's not that far away. So we'll talk about what might happen. By 2035, it's projected that the number of Americans 65 and older will increase from approximately 61 million last year to about 77 million. So it's a lot more people likely starting to claim Social Security. That same year, the numbers work out that there's projected to be only 2.4 covered workers for each Social Security beneficiary. Currently, there's 2.7 workers, right? So right now there's more people paying into Social Security than we're expecting to be in a decade, and significantly more people claiming benefits. So that's not a good ratio, obviously, for the potential sustainability of Social Security. The Disability Insurance Trust Fund, Social Security disability income, which is slightly different, is projected to be depleted in 2098. So that's got a few more years. So what might happen, right? Because of these projected changes, I think most people would anticipate changes to Social Security. That, nobody really knows what that's going to entail, but it could come in a number of forms. As we talked about in one of the earlier slides, right, there's currently a maximum amount of income that is subject to Social Security tax. So that could get increased. The benefit calculation that somebody's entitled to could get changed, right? They might lower that. The full retirement age could get extended. It might be currently, like I said, for most people, it's 67. That could get extended. The percentage of Social Security tax that you have on your current earnings, that could get increased, right? We don't know exactly. It might be a combination of those things, but the likelihood is that we will see changes because nobody wants to see Social Security be depleted in 9 years.
Well, the other questions are mainly, to do with like more individual situations. But I would say that if you have these questions, schedule your free financial assessment with either Allison or one of our professionals, and they'll take a deep dive into your particular needs and what, not just Social Security, but everything about maximizing your retirement plan, minimizing your risk, et cetera. So, Allison, thank you so much for everything that you all of your knowledge and just how easily you give it to us.
Yeah, you're welcome. Hopefully it was mostly understandable.
It
Like I said,
was.
there's a lot of moving parts of Social Security, so try to make it as straightforward as possible.
Well, thank you so much, everybody. Have a great day.